Okay, I'm just gonna say it straight. The US government now spends more on debt interest than on Medicare. Not defense, not roads, not schools. Interest on debt. More than the program keeping 65 million Americans out of medical bankruptcy. And before you go, Max, that's a government problem. I've got my own bills. I need you to stay with me for just a second. Because that number, that budget line, it is already inside your life. It's in your mortgage rate. It's in your grocery bill. It's in why your rent went up and your paycheck didn't feel like it did. This isn't political. I don't care who you voted for. A spreadsheet doesn't have a party. And the federal budget is just a very uncomfortable spreadsheet. So today, we're going to follow the money, all the way from Washington, D.C. to your actual wallet. And I'm going to show you what I did when I finally figured this out because I was late to it, embarrassingly late, and I don't want that for you. I'm Max. This is Max Wealth. Let's get into it. All right, so real talk before anything else. Before we even get to the trillion-dollar stuff, I want to talk about where most people actually are right now, because I think a lot of people watching this are doing the same thing I was doing a few years ago. I had a job. Decent job, honestly. Got paid every 2 weeks, money hit the account, and I paid my bills, grabbed some food, maybe saved a little. And I genuinely thought I was doing okay, like I wasn't broke. I wasn't in some spiral of credit card debt. I was fine. Except I wasn't building anything. Month in, month out, the number in my account looked about the same. Sometimes a little more, sometimes a little less. And I had this vague sense that I should probably be doing something smarter with my money, but I didn't really know what, so I just didn't. Sound familiar? I think it sounds familiar to a lot of people. Here's the thing that woke me up. I read this Federal Reserve survey from 2023, and it said 37% of Americans, over a third, cannot cover a $400 unexpected expense without borrowing money or selling something. Not $4,000, $400. That's a busted tire. That's an urgent care visit. That's your washing machine dying on a Tuesday. And I thought, okay, I'm not in that 37%, but I was closer to it than I wanted to admit. Then I looked up the personal savings rate. Bureau of Economic Analysis, early 2024. Americans were saving about 3.4% of their income. After World War II, that number was closer to 17%. We went from a country that saved nearly a fifth of everything we earned to one that barely saves a 20th. And meanwhile, the national debt is $36 trillion and climbing. You see the problem, right? It's not just that the government is broke. It's that the government is broke and so are most of the people in it. That combination. That's when things get uncomfortable fast. Okay, the debt machine. Let me break this down in a way that actually makes sense. Forget the trillions for a second. Let's talk about your neighbor. Let's call him Bob. Bob makes $60,000 a year. Solid income. But Bob spends $85,000 a year. Every single year. Has been doing it for decades. So every year, Bob borrows the difference. Started with family, then the bank, then whatever line of credit he could get. And now Bob owes $400,000. And it's growing because he's still spending more than he makes every single month. Now imagine Bob is not your neighbor. Imagine Bob is the United States of America. The U.S. government brings in roughly $4.4 trillion in tax revenue a year. It spends around $6.5 trillion, that $2 trillion gap, every single year, gets slapped onto the national debt. And the debt is now so large that just the interest on it costs over $1 trillion annually. $1 trillion per year, just in interest. That's more than Medicare, more than the U.S. defense budget, more than basically anything else in the budget. Just servicing the interest on old money borrowed by old governments for old spending. And here's how that becomes your problem. Specifically, practically, in your actual life. When the government needs to borrow, it sells treasury bonds. And to attract buyers, it has to offer a return, an interest rate. And when the government is competing for trillions in lending every year, it pushes rates up across the entire economy. Every bank, every lender, every financial product. They all price off those treasury rates. So when government borrowing goes through the roof, your mortgage rate goes up. Your car loan gets more expensive. Your credit card APR creeps higher. Small businesses pay more to borrow, which means they hire less or raise prices. And again, somehow, that ends up in your grocery bill. Mortgage rates went from about 3% in 2021 to over 7% by late 2023. The monthly payment on a $400,000 house didn't just go up a bit, it nearly doubled. That's not the Fed being mean. That's the math of a government that borrowed too much finally showing up at your door. Let me tell you about the Tuesday. Everything changed for me. It was nothing special. I got home, checked my mail, and there was a letter from my landlord. Rent going up $300 a month. $300. And I sat down and started doing the math on my phone, and I realized I've got nothing. Like, no play here. I can't negotiate this. I can't cut $300 worth of expenses without it really hurting. I can't just manifest $300 in extra income by next month. I was completely at the mercy of a situation I hadn't prepared for, and that feeling, that helpless, stomach-dropping feeling of having no options. That was the moment I got serious. Because here's what was happening all at once. Inflation was eating my purchasing power. My savings account was earning something like 0.5% interest, while inflation was running at 8%. So every dollar I had saved was quietly losing value every single month. And because rates had gone up so fast, buying a home, which I'd always thought of as my escape from rising rent, had just gotten way more expensive overnight. I was running in place, financially, and the ground was moving backwards. And the thing that really got me, the thing that made me actually angry, was realizing that nobody had ever taught me any of this. Not school, not my parents, and they weren't bad with money, they just didn't know either. The financial system is incredibly complex, and nobody sits you down and walks you through how it works until it's already working against you. But here's what I figured out. It's not too late. It really isn't. And honestly, the people who figure this stuff out during times of economic stress, these weird in-between moments like the one we're in right now, those are the people who come out to the other side in a genuinely different position. Let me show you how. I need to talk about inflation for a minute because I think it's the most underrated threat to ordinary people's finances. And the reason it's so dangerous is because it's invisible. If someone walked up to you on the street and took $19 out of your wallet, you'd notice. You'd be upset. You might even cause a scene. But between 2020 and 2024, the US dollar lost about 19% of its purchasing power. That $100 grocery run from 2020, $119 now for the exact same stuff. And it happened slowly enough that most people barely registered it. They just noticed things felt tighter. They weren't sure why. That's the inflation illusion. Your bank balance looks fine. Maybe it even went up a little. But the stuff that balance can buy, that went down. You got poorer while your account grew. That's the trick. And here's what makes it really sinister in the context of the national debt. When the government runs a deficit, spends way more than it takes in, and prints money to bridge the gap, it devalues every dollar already in existence. Inflation is basically a tax that nobody voted for, and most people don't even realize they're paying. Now, here's the part that changed how I think about everything. Inflation destroys cash, but it does something completely different to assets. Real estate values go up in nominal terms during inflation. Stocks go up, businesses go up, commodities go up. The people who own things, actual things, equity, property, productive assets, they get at least partially protected. The people who hold cash watch their savings melt. And I was holding cash, all of it, because it felt safe. It wasn't safe. It was just slow enough that I couldn't feel it bleeding. So, the shift I made, and this is the one I want you to take from this video more than anything else, is I stopped thinking like a saver and started thinking like an owner. And I know that sounds like something on a motivational poster, but I mean it very literally. Saving is defense. You need defense. But defense alone doesn't win. At some point, you have to put money to work. You have to own something that grows while you're not looking at it. The most straightforward version of this, the thing that most financial experts agree on, regardless of their other differences, is a low-cost index fund that tracks the broad stock market. something like an S&P 500 index fund. I know, you've heard it. It sounds boring. It sounds like something your dad says. Bear with me. The S&P 500 has returned an average of about 10.5% per year over the past 50 years, through recessions, through crashes, through 2008, through COVID, through inflation spikes, through all of it. Not every year. Some years it's down hard, but over time, consistently, it goes up. Compare that to a savings account at 0.5%. Over 30 years, the difference isn't just a bit better. It is the difference between financial security and financial dependence. Here's the math that hit me like a truck. If you invest $500 a month starting at 25 and average 10% per year, you hit roughly $3.2 million by 65 if you wait until 35 to start. Same $500, same 10%. You're looking at about $1.1 million. 1 decade of waiting costs you over $2 million. $2 million gone. Not because of bad decisions, just because of waiting. That's compounding. And it's either working for you or it's not. There's no in between. Here's something I want you to sit with for a second, because this one surprised me when I figured it out. The same interest rate environment that's making your mortgage brutal, it's also creating an opportunity most people are completely ignoring. When the Fed raises rates to fight inflation, suddenly, safe, boring assets start paying real money. In 2023 and 2024, high-yield savings accounts were paying 4, 5, even 5.5%. Treasury bonds, the same ones the government sells to finance that $36 trillion debt, were paying similar rates. I-bonds earlier were paying over 9%. That's not stock market returns, but for money you need to keep safe. Your emergency fund, money you'll need in the next 1 to 3 years. Getting 5% guaranteed beats the heck out of 0.01% in a regular checking account. So what I did was simple. I moved my emergency fund into a high-yield savings account. I put some short-term savings into treasury bills, locked in some real yield on money that was just sitting there, doing nothing. Not complicated, not risky, just paying attention to what the rate environment was actually offering. But then the flip side, and this one really matters. High rates are a screaming signal to destroy your high-interest debt, because here's a number that should make you genuinely uncomfortable. The average credit card APR in the US crossed 22% in 2024. 22%. There is no investment. Not stocks, not real estate, not crypto, not anything. That reliably returns 22% per year, which means paying off a credit card balance is literally the highest guaranteed return available to you right now. Bar none, nothing beats it. So my rule, and I hold this pretty firmly, before a single dollar goes into investments, every credit card balance is dead, because you can't outinvest a 22% drag. It's mathematically impossible. Okay, the question I know a lot of you have, the one I had. When does this actually break? Like, when does the debt situation go from uncomfortable background noise to actual crisis that I cannot ignore? And I want to be straight with you here. Nobody knows. Genuinely. Not the Fed, not the IMF, not the smartest economists on the planet. Sovereign debt crises are weirdly hard to predict. Countries can carry enormous debt loads for longer than anyone expects. And then confidence cracks, and it happens almost overnight. But there are 3 scenarios worth knowing about, because understanding them helps you position yourself regardless of which one plays out. The first is the interest rate spiral. Rates stay high. The interest on the debt grows faster than tax revenues can keep up. The government borrows more to cover the interest on what it already borrowed. The Congressional Budget Office has actually modeled this. Under current policy, the debt-to-GDP ratio could hit 180% by 2053. That's not a fringe prediction. That's the CBO's own numbers. The second is a dollar confidence crisis. This one's slower moving, but potentially bigger. The dollar is the world's reserve currency. It's what most global trade gets settled in, what most central banks hold as their main reserve. That status gives the US this extraordinary privilege to borrow way more than other countries could. But if that trust erodes, if big economies start trading in other currencies, that privilege disappears. And we've seen early movement here. BRICS nations have been actively pushing alternatives. It's not a crisis, but it's a direction. The third scenario is just domestic political pain. At some point, the math forces a choice: raise taxes significantly or cut benefits. Medicare, Social Security, programs that millions of people depend on. Neither is politically easy. Both are eventually unavoidable if the trajectory doesn't change. And look, you don't need to pick which scenario you believe in. You just need a financial life that survives all three. That's the goal. So here's the framework I actually used. I call it the financial fortress. 5 layers built in order, and the order matters. Layer 1. Your foundation is an emergency fund. 3 to 6 months of real living expenses, not invested, not in the market, in a high-yield savings account, liquid, available tomorrow if you need it. This is the most important thing. Without it, one bad month, one medical bill, one job loss, one car repair wipes out everything else you're trying to build. If you don't have this yet, stop here. Build this first. Everything else waits. Layer 2. Eliminate toxic debt. Anything above roughly 8% interest. Credit cards, personal loans, buy now, pay later balances, gone. Aggressively. The psychological weight of debt is real, but the mathematical weight is worse. It is dragging on every financial decision you make. Kill it. Layer 3. Automated investing. 401k first, especially if your employer matches. Free money. Take all of it. Then a Roth IRA if you're eligible. $7,000 a year in 2024. Tax-free growth. Tax-free withdrawal and retirement. If you can hit that consistently for 30 years, the math gets genuinely exciting. Layer 4. Grow your income. This one gets skipped a lot, and it shouldn't. Cutting expenses has a floor. Income has no ceiling. Learning a high-value skill, negotiating a raise, starting something on the side. These aren't just hustle culture buzzwords. People who switch jobs voluntarily earn 10 to 15% more on average. Sometimes the highest return investment you can make is a few months improving a skill that your employer, or a different employer, will pay significantly more for. Layer 5. Income-producing assets. Over time, not all at once. Real estate when the numbers genuinely make sense in your market. Dividend stocks. A small business. Something that generates cash that isn't directly tied to your hours. This is the long game. This is where financial independence actually lives. You don't build all 5 layers in a month, but you build them in order, and you start today. Let me zoom out one more time. The US isn't the only country dealing with this. Japan's debt-to-GDP ratio is over 250%. The UK is wrestling with its own fiscal pressures. This is a global moment of governments that borrow too much, finally feeling the consequences. And what's interesting, and useful to know, is what sophisticated investors are doing about it. Sovereign wealth funds, institutional money, genuinely wealthy individuals, they're not panicking. They're diversifying. Hard assets, real estate, infrastructure, commodities, gold. Central banks bought over 1,000 tons of gold in 2023. 1,000 tons. These are the institutions that literally hold the world's money. And they're quietly moving a slice of it into something that isn't dependent on any government's creditworthiness. That tells you something. I'm not saying go buy gold bars, but a 5 to 10% allocation toward inflation-resistant, real assets. That's not paranoia. That's just not having all your eggs in one basket, especially a basket denominated in a currency that powerful institutions are starting to quietly hedge against. Own things, equity in companies, fractions of real estate, actual productive assets. The people who get hurt worst when monetary systems wobble are the ones holding only claims. Cash, bonds, savings accounts. The people who own actual things tend to weather it better. I want to say one more thing before the CTA. I know this stuff can feel heavy. $36 trillion. Inflation, interest rate spirals, dollar credibility. It's a lot. And it's easy to go from I should do something to this is too overwhelming to just closing the tab and going back to whatever you were doing. I've been there. I stayed there for longer than I should have. But here's what I know now that I didn't know then. The macro stuff. The national debt, the Fed decisions, the political fights over the budget. None of that is in your control. You can't fix it. You can't time it. You can't vote it away by next quarter. What is in your control is the micro, your habits, your accounts, your debt, your savings rate, your next financial decision. And the gap between people who end up financially okay and people who don't, it's almost never about intelligence. It's almost never even about income, at least not at the start. It's almost always about whether they started, whether they built the habits, whether they did something when they knew they should. You now know you should. 36 trillion, and it's going up. That headline is coming back next month, and the month after. And 5 years from now, it'll be a bigger number and most people will still scroll past it. But not you. Not after this. So here's what I want you to do. Pick one thing from today. One, not five, not a whole financial overhaul. One thing. Do it tonight. Open the high-yield savings account. Log into your 401k and bump your contribution by 1%. Write down every debt you have and the interest rate next to it. Send the email about the raise. One thing. Because the debt machine doesn't care whether you're ready. Inflation doesn't wait for a convenient time. The best moment to build your fortress was 10 years ago. The second best moment is tonight. If this helped, share it. Someone in your life needs to hear this, and they're not going to find it on their own. Help them out. I'm Max. This is Max Wealth. Go do the thing. I'll see you in the next one.